This year, for the first time since 1979, gold went vertical. A record passed $5,500 an ounce. Then it crashed a quarter of its value, back to $4,000. But here's the strange part. While Western traders panic sold, China's central bank bought the most gold in years, into the drop. So here's our base case. The floor under gold isn't the speculators. It's central banks and China taking the physical metal. What flips it is the day those buyers blink. Quick ground rule. Nothing here is advice. We map what's happening and how it breaks. To understand the floor, you have to see that there are really two gold markets, and they just split apart. One is paper gold, the funds and futures most Western investors actually own. That's the market that crashed. When gold fell, exchange-traded funds saw some of their biggest outflows on record. And by mid-year, roughly 300 tons of that ETF gold was sitting underwater, bought higher, now at a loss. That's a crowd that sells when the price drops. The other is physical gold, actual bars, delivered and vaulted. And that market did the opposite. As the West sold paper, the metal itself flowed east. And the buyers there don't flinch at a lower price. They welcome it. The clearest gauge of that second market is what the world's central banks are doing. For 3 years running, they've bought over 1,000 tons of gold a year. Even in 2025, after the price had already tripled, they bought 860 tons, nearly double their average for the entire decade before. Why the sudden hunger? The turning point was 2022, when Western governments froze roughly $300 billion of Russia's reserves overnight. Every central bank on Earth took the same lesson. Dollars in someone else's system can be switched off. Gold in your own vault cannot. So they've been swapping one for the other ever since. Gold has now quietly overtaken U.S. Treasuries to become the second largest reserve asset in the world. And this buyer does not care what the chart looks like. It's price insensitive, which is exactly what a floor is made of. No one embodies that shift like China. And it's not just buying, it's rewiring the whole plumbing of the gold market to run on physical metal. Start with the buying. China's central bank has now added gold for 20 straight months, its longest streak on record. And its single biggest month in over 2 years came in June, as the price was falling. Some analysts think the true number is several times what's officially reported. Then the imports. China pulled in nearly 700 tons of physical gold in the first half of the year, up more than 70%. And here's the part most people miss, the market structure. Last year, Shanghai opened its first offshore gold vault in Hong Kong. Gold priced in yuan and physically deliverable. You can take the bar. That's a deliberate contrast with London, where more than 90% of gold trades never touch metal at all. They're paper claims. Beijing has also started letting its giant insurers hold gold for the first time, and is loosening the rules on moving it across the border. Piece by piece, China is building a market where the thing that matters is the metal in the vault, not the claim on a screen. Put it together and you get the base case. When a huge permanent buyer purchases more as the price falls, they don't just cushion a drop, they set a floor beneath it. Official buying now soaks up close to 1/3 of all the gold mined each year. The people who set the price at the margin are no longer nervous Western traders. They're patient governments who measure in decades. The World Gold Council's own base case has gold holding in a range around 4,000, with dips bought. Now, be fair, because a floor is a claim and there are real ways it cracks. Steelman the bear. First, the buyers aren't all one way. Even among central banks, some are selling. Russia just sold more gold in 6 months than it had in 25 years. And the overall pace of official buying in 2025 was actually lower than the year before. A floor made of buyers weakens the moment enough of them turn into sellers. Second, the price of not owning gold is rising. Gold pays no interest, and with the new hawkish Federal Reserve under Kevin Warsh pushing back on rate cuts, long-term Treasury yields are back above 5%, and the dollar is near a one-year high. Every extra point of real yield is a reason to sell gold and collect a coupon instead. And third, in a genuine cash scramble, gold is what you can sell. So a liquidity shock could force the very holders now underwater to dump it. The floor is real. It is not unbreakable.
So, our base case, the most likely read, not a prediction.
The speculative bubble in gold has already burst. That part is over. But underneath it, a different market is holding the line. Central banks and China, buying the physical metal on a schedule that a falling price doesn't interrupt. So gold most likely grinds sideways to firmer around 4,000. Not roaring back to the highs, but not collapsing either, because every dip meets a buyer who is going to buy anyway. A floor, not a moonshot. Two things break that. One, the buyers blink. China's streak stops, more central banks turn seller like Russia, and the price-insensitive bid that built the floor simply steps back. Two, real yields win. The Warsh Fed stays hard, the dollar keeps climbing, and the pull of 5% treasuries finally overwhelms even the official buying. One flip is about demand drying up. The other is about the alternative getting too good to ignore.
So, we don't predict. We watch three tells.
1. China's monthly gold report. As long as that streak runs, the floor has its foundation. The month it stops is the month to pay attention. 2. The dollar and the 10 and 30-year yields. If real yields keep climbing and the official buyers still hold the line, the floor is strong. If they wobble together, it's cracking. 3. The gap between the two golds. Watch Western ETF flows against Chinese imports and Shanghai withdrawals. As long as the metal keeps moving east while the paper sells in the west, the physical floor is intact. Watch those three, and you'll see whether the floor under gold holds, long before the price tells you. For a generation, the story of gold was told in New York and London, in funds, futures, and paper claims. That story just had its crash. But the next one is being written in vaults in Beijing and Shanghai, one physical bar at a time, by buyers who see a lower price not as a warning, but as a discount. Whatever gold does next, the hands holding it have changed. Not financial advice. Scenarios, not recommendations. If you want the clear-eyed version of what's actually moving markets, the base case, and what flips it, subscribe. New read every week. Crosswind Economics.